Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes, but when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
Right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome to this month's Financial Opportunities Forum. Before we start, I'll announce the forthcoming dates. The next FOF will be on September 19th, Thursday, same place. And the month after that, October 17th, which is again a Thursday. So Thursday, September 19th and Thursday, October 17th. We started our Financial Opportunities Forum 10 years back or more than 10 years back. And at that time, it was 100% attended by people from Rotary Club of Bombay Midtown. So from that time to today, where 90% of the people are not from Rotary Club, it gives me great pleasure to welcome the immediate past president of our Rotary Club, Deepak Garg. Welcome, and his friend who's also attending our session today. Also, hearty welcome to people who are joining us in Bangalore and in Delhi. So each month we try and discuss sectors, companies which we feel would be interesting to the audience. But for a few months now, people have stopped listening to us. They are not interested in what's happening to individual sectors, companies, which sector has pricing power, which company has a moat, how are industry trends shaping up. People are just interested in what is happening to the markets and what is happening to the economy. And those are the kind of questions which have been put forth to us on social media, via emails and in one-to-one conversations. So I said today it will be pointless talking about anything else, but we'll have to talk about broadly what is happening in the financial markets, in the economy, and give some context. So those of us who are addicted to streaming media services, we know that season 1, season 2, season 3, they keep on elongating the story, and one after the other, sequels keep coming. So sequels are in effect a reflection of lack of original ideas. Same way in movies. So you have Mission Impossible 1, 2, 3, and newer versions keep coming up. So we have our own version of sequels. So we have had The Boy Who Cried Wolf in the past. So today is the return of The Boy Who Cried Wolf. So it's a sequel which we have seen in the past. Like in any sequel, first you start with some context of what has happened in the past, the story so far, and then you take the story forward. So we look at what all we have been saying over last 3-4 years, and where we stand today, and where do we see things going forward. So broadly, on April 20th, 2015, and that time we were in Malabar Hill Club. That time we had this presentation, The Emperor's Clothes Are Torn. After that, in April 2017, again I wrote a note in the fact sheet, and then 22nd August 2017, we had called out 3 sectors, consumption themes, FMCG and auto in India, small and mid caps, and NBFCs. We have said these are looking very, very frothy. And then again, June 20th, 2018, I had made this presentation, The Boy Who Cried Wolf. So these are the 4 points where we had said something about the market in general. So today is the 5th installment of that. So these are slides exactly as they were in the past. So this is not today's slide. This is slide copied with all its flaws, all its imperfections as it is. So at that time, in April 2015, we had said that there is disconnect in valuations of some quality large caps and select mid caps. That time, it was not a bubble kind of thing. Some select names were looking frothy. And being the imprudent person that I am, I had also taken the foolish step of naming those companies at that point in time. So these were the companies I had named. Again, the slide is an exact replica. There's no editing that has gone, no additions, no deletions. So how have these companies fared over the last 4+ years? Actually, not too bad. Some companies have fallen, some companies have more than doubled. So on an average, per annum, they have given 6 quarters. So it's almost like a tie or a stalemate kind of scenario. Neither have they lost too much money, nor have they made any significant amount of money. So they've made just about money market kind of returns. Then this is April of 2017. Again, I foolishly put out some names. Again, they have on an average delivered 8.4% per annum. So somewhere slightly better than money market. Again, they haven't really fallen as much as I would have thought. Again, this is an old slide. That time I had said NBFCs, FMCG auto, small and mid caps. So if I had left it to this, I would have been broadly okay. I could have claimed NBFCs have fallen. But the trouble is that the NBFCs which actually fell were not the ones that I had named. So I did not name Island FS, I did not name DHFL or India Bulls or any of the NBFCs which have fallen. I named things like Group Finance and all that, which actually haven't fallen. So, and Bajaj Finance, thankfully, I did not name. So, yeah, again, DMart hasn't really fallen. So these are the, this is the last year's thing. Now, last year, around this time, June of 2018, I had put this chart. This is the yield on US 10-year Treasury securities. So from a peak of 16% per annum, and these days it seems to be difficult to believe, but US government bonds were paying 16% interest rate per annum. This was in early 80s, 1980. So over the years, interest rates kept falling right here. And then I somehow saw that the party seems to be coming to an end. We are so close to zero now that they can't go down any further. And even the US Federal Reserve at that point in time was making bold statements. We will suck out $50 billion from the market every month and we'll shrink our balance sheet over a period of time. They also raised short-term interest rates for a while. So I thought party seems to be coming to an end. The high valuation party fueled by cheap money seems to be coming to an end. This was June of 2018. So as I said, it's something like a stalemate. It's not that I'm trying to boast that maine bola tha, everything turned out to be correct. While small and mid caps corrected, some of the names that I thought were overvalued haven't really fallen. FMCG hasn't really fallen. Auto has fallen quite a bit. NBFCs have fallen, but again, I got the sector right, but some of the stocks that I thought were frothy actually have held on quite well. So that's where we stand today. How do we see things going forward from here? And that's really what we are interested in today. The first question that people keep asking, and people are obsessing about this, that, oh, US 10-year yields have gone below US 2-year yields, inverted yield curve. Does it mean recession? Anyone who's done finance, or you don't need to do finance for this, it's actually arithmetic. Let us say 1-year interest rate is 10% and 2-year interest rate is 9%. Okay, 1-year interest rate is 10% and 2-year interest rate is 9%. Logically, it would mean that people expect the interest rate between year 1 and year 2 to be 8%. If that is the case, first year 9%, second year, first year 10%, second year 8%, the average for the 2-year period would be somewhere about 9%. According to me, that's all it means, where short-term interest rates are higher than longer-term interest rates. People are thinking too much, people are extrapolating too much, saying that somehow the bond markets have a magic formula of predicting what will happen to either the economy or to stock markets in the future. What is going to happen 1 year from now, 2 years from now is not known by anybody, least of all people who trade bonds. The reason why long-term interest rates are so low is that central banks the world over, this is European Central Bank, Swiss National Bank, Japanese monetary authorities, all of these have been just simply manipulating their interest rates and currencies in the hope that their exports will become more attractive and they will export their troubles to other countries and prosper. But when everyone plays the game, it does not benefit anybody. It's like if people in the second row stand up to get a better view of the screen, people in the third row will have their vision blocked. They will in turn stand up. And then people in the fourth row will stand up. So if everyone tries to stand up, no one gets a better view. So same way, if everyone lowers the interest rates, all currencies tend to lose value and no one really gains out of that currency war kind of situation. So this is as far as the yield curve goes. The other factor that people worry about is the headlines that we are seeing in newspapers these days. Auto industry has sacked so many temporary workers. Inventory at dealers is at record levels. Car sales are not happening. Bike sales are not happening. Economy is in recession. Will it end ever? What will happen to the economy? Consequently, what will happen to the stock market? My simple question to you is, and that question will come later, let's look at these two stock price charts. This is stock price chart of Maruti Suzuki. Somewhere here, uh, late 2017, early 2018, stock price was close to 10,000. 9832 was the high. And currently, it's about 6,000 here, 5963. So something that was 10,000 has come to 6,000, roughly 40% discount from the top. Okay, this is Maruti. This is Eicher Motors. High was 32,861 and currently at about 16,470. Roughly half of the highs that were seen. What was happening here? There was a waiting period for cars. There was a waiting period for bikes. What is happening here? Inventory pile up is there. Production cuts are there. So my question is, should you buy a stock when waiting list is there or when production cuts are there? Okay. If you are in the market for cars or a bike, should you buy when there's a waiting period and someone is asking you to pay up 1 lakh rupees more for getting priority delivery, or should you buy a car or a bike when dealers are offering you discounts? Typically, as consumers, we wait for discounts before we purchase anything. Whereas in stocks, we want the newspaper headlines to be screaming everything positive. Only then we want to buy. Why don't you buy when stock prices are at 50%? Is it that these things will remain forever? When stock prices were here for Eicher Motors and for Maruti and all of that, story was Maruti sells 1 in 2 cars in India. Such a strong company. Auto penetration in India is so low that so many people are yet to buy cars. It's a decadal story. Next $1 trillion, next $2 trillion, $5 trillion. Again, when per capita income of consumers goes beyond a certain point, people stop spending on food, shelter, clothing. They have more discretionary spend. They go out and buy on things like cars and vacations and all of that. Eicher Motors, Royal Enfield, iconic brand. Foreigners will buy that brand because they associate with that heritage. And it's a status symbol, and so many people will upgrade from just commuter bikes to luxury bikes. And again, we don't have the purchasing power to buy a Harley Davidson, but we will surely buy a Royal Enfield. So where did all those stories go? Mind you, any item of expenditure that is discretionary in nature is always going to be cyclical. If you are hard pressed for money, you can postpone upgrading your car, you can postpone getting your house painted. You will not cut down on monthly groceries, or you will not cut down on your electricity spend. So utilities will have its own trajectory, and discretionary items will have their own trajectory. And just today afternoon, I was listening to Mr. Pawan Goenka, M&M. He made a very interesting point. He said in last 2 decades, in last 20 years, we have had 4 slowdowns in auto. 2001, 2, 3, around that time. 2008, 9, 2012, 13, around that time. And this is the 4th one. So on an average, every 5 years, we are seeing this situation. So what is there to get worried about? It's almost like monsoon season follows summer, winter follows monsoon, and again you have a summer. So you have a slowdown period and you have a period when things are going fine. The whole point is that, again, remember what Buffett keeps saying. If you want cheery consensus in the market and if you want headlines to be very positive, you'll buy auto stocks at double the level at which they are quoting right now. And if you have the patience to buy them somewhere here, I'm not saying it will immediately turn around and go back there. I'm not making that point. Maybe after you buy here, it will still come down another 20%, 30%. I don't know where the bottom is. I don't know when the turnaround will happen. All I know that it's not that we are doomed forever. Don't make that mistake. Don't get into that trap. The whole context of giving you those past presentations that we have made, those past letters that we have written, is that we have been cautious for close to 3.5 years. From 2015 to mid 2018, cash kept building up in our portfolio. We had a peak of 30% cash and we have started deploying. Now we are down to 14% cash. This is the time to actually start investing, to look at investments, and not a time to get into your shell. Because if you buy only at the time of optimism and if you are going to sell at the time of pessimism, you will do opposite of what is good investing. Good investing is buy cheap and sell when things are expensive. If you are driven by news flow, you will buy when things are expensive and sell when things are cheap. Don't fall into that trap. And for anyone who's feeling too pessimistic about either the global scenario or about the Indian scenario, and doesn't matter whether you are interested in finance or not interested in finance. This, what I'm going to recommend now, has nothing to do with investing or finance. It's about living our lives. Do yourself a favor, listen to this 2-hour talk, and if you don't have 2 hours, at least spend 1 hour. Listen to the first 1 hour of the talk. It's called Know Your Country. It's a talk by a person called G. Maran. He gave this presentation at the CFA Society event. It's there on YouTube. You've seen the person and you've seen the title. So it's easy to search. The talk, the first 10-15 minutes of the talk is not even a talk. It's a quiz. He just goes on asking you questions and giving you 3 options. It's a multiple choice Q&A kind of thing. This is on India. If ever you feel too pessimistic about India, just listen to this talk. And similarly, and this talk again is based on a book in the global context. If you feel too pessimistic about the world as we live, just read this book. If you don't have the patience to read a book, Google the name of the author. He has wonderful TED Talks also, Hans Rosling. highly recommended. Uh, yeah, the talk is on YouTube as well as on TED.com. Okay. Comes recommended by various people, including Bill Gates. The author has unfortunately passed away now, but the points that he makes are very, very remarkable. So don't feel too pessimistic. I don't think there's anything wrong with either India or the world. All the things that we were positive about are actually there. Are oil prices a worry today? No. Is currency stable? Yes. Is inflation stable? Yes. Are we at war with anyone? No. So this news headlines, something or the other will keep happening. So Article 370 and Kashmir and US-China trade war or something like that. But it's not that we are in a Gulf War or in a World War kind of situation, or where we are having to pledge our gold to uh, meet our import needs or anything like that. It's a very, very normal time. It's a very, very good time in terms of macros. Everything else is stable. We are in a cyclical downturn. Sure, auto sales are down and some corporate earnings are not that great, and some uh, leveraged companies are facing financial trouble, but nothing beyond that. So let's leave these things here. Let's now look at two star charts, and this is what I think is the biggest story right now. If one is looking at the uh, economy, or if one is looking at the prospects for financial markets. Uh, so the earlier chart I showed was incomplete. This is where US interest rates were rising, and this is where I thought cheap money party seems to be coming to an end. And look at what happened after that. US Federal Reserve has thrown in the towel. They have withdrawn that uh, $50 billion unwind that they were to do of the balance sheet. They have, instead of raising rates, they have now again started cutting rates. So US has reversed course, mainly led by European central bank cutting rates. So European rates are negative. If you put money in euros in your bank account, the banker will say, give me 100, I'll give you back less than 100 after some time. Guaranteed. So you will not get any positive interest rates, you will get negative interest rates. That's the scenario in Europe. So not for small amounts. $17 trillion worth of securities in the world today are trading at negative yields. That's 17 by followed by these many zeros. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 zeros. 1 billion is 7,100 crores of rupees. $1 billion. 1 trillion is 71 lakh crore rupees. 71 lakh crore rupees multiplied by 17, that's the amount of money traded in the world today, which is giving you negative interest rates. You give money, you will get back less than what you have given contractually. The borrower is not going to default. He's going to, by contract, give you less money than what he is borrowed. In rupee terms, these many rupees worth of securities. Difficult to get your head around this number because somewhere you just see zeros. You can't get your head around to how much money this is there. So with this, what all can you do? It's very difficult to imagine. So let's say what is the market cap of India's stock exchange? Less than a trillion, right now? Less than a trillion? In dollars? 2 trillion? Okay. So 2 trillion. So 17 trillion worth of securities are at negative yield. So this is 8.5 times are all the listed companies in India. So imagine if you had this much money, why would you keep that much money at negative yields? Why would you not buy all the companies which are listed in India? So in history, there have been these significant events which simply shook the people. So at one point in time, people believed that the earth is flat and that the sun goes around the earth. Then suddenly someone came, Copernicus came, and then Galileo followed, and they said, no, no, earth is a globe and earth goes around the sun. That was a big change in mindset for people, right? And Einstein came and said, time and space are relative. There's nothing like absolute time, there's nothing like uh, absolute space. So if you go at half the speed of light and return after 10 years or 15 years, then your daughter will be older than you, or some such crazy thing, right? So it's very difficult to get your head around some concepts. Then again, all medical practitioners, they had never encountered HIV, so that was a new disease. They do not know how to treat it. Or let's say antibiotic resistant superbugs. People don't know how to treat them. Again, nutrition. Dietary fat is bad, you should have carbs. Then suddenly, no, no, carbs are bad, now I have dietary fat. So nutrition gets turned on its head. We are facing a similar situation in finance. All along, we have said that money received in the future is less valuable than money received today. So you discount that to present value and you have a positive cost of capital. Now, how do you factor in $17 trillion worth of negative interest rates in the world? If you do DCF, and if you, DCF is the technical name for discounted cash flow, it's very simply the compound interest formula that we learned in high school. A equal to P into 1 plus R raised to N. Right? So typically that formula was you put in 100 rupees. If your interest rate is 15% per annum, after 5 years you will get 200 rupees back. If your interest rate is, let's say, 10%, you will double your money in, let's say, around 7 years, plus or minus something. But what if interest rates are negative? After you keep money for 5 years, you will get back less than 100. How does one do finance with that kind of mathematics? So we are facing this relative space-time kind of situation in finance. As finance professionals, we are not equipped to deal with this at all. And this is resulting in some crazy things in the real world. This is not just some academic thing. This is not just some thing which happens in bond dealing rooms in bank treasuries. This is affecting real people in real life. Let's see how. This is the global bond market right now. Around close to 30% of all the bonds which are trading in the world are sub-zero. Another maybe 8-9% are trading at yields less than 0.5% per annum. And only about 40%, oh sorry, only about 40% of the securities are about 2%. And things which trade at more than 5% yield are less than 5% of all the bonds which are traded. So we are living in a world of extremely low interest rates or negative interest rates. Anyone wants to move to Denmark? Because in Denmark, if you borrow home loans and you pay EMIs to the bank, you have to pay back less than the principal. Borrow 100, pay back only 95 or something like that. Not fake news, real news. So, all the people who are worrying about recession, about things being bad, are like people who, even after knowing that there's, okay, let's watch the video first. I'll give context of this video later on. Just think of this gentleman in the white shirt as a central banker somewhere, as the governor of European Central Bank or Swiss National Bank or Japanese Bank or Jerome Powell, who's opened the floodgates on a dam which is overflowing. This is all the money that they are pumping out of their reservoir. And look at what that causes down the line. Look at the poor fellow who's going to come on your screen trying to drive a car on the road. Sounds familiar, right? We had this situation not too long back in our own city. So at one end, the floodgates are open. So don't worry about water supply cut at your residence. Worry about something else, but don't worry about shortage of water. Don't worry about lack of liquidity. Don't worry about recession. If we are sleepy, what do? We have maybe a cup of tea or coffee. Instead of tea or coffee, what if we are hooked to intravenous caffeine through a bottle? If we have pain, if we have a headache, we take one pill. What if you were overdosed with morphine for a headache? That would have pretty dangerous side effects, right? And your headache or your sleepiness would be the least of your worries. We are in the same situation. Don't worry about slowdown or don't worry about recession. That's the least of the worry. The biggest problem is the bubble in bonds and the consequent asset bubbles, which it is going to create the world over. The floodgates at the dam, at the river, have been opened already. That flood is coming down the river. Don't worry about water supply cut. Worry about flooding. So don't sit in cash or don't twiddle around. This is one of the entities which is creating that flood, Swiss National Bank. What are they doing? They are buying US equities. And what are they buying? Microsoft, Apple, Amazon, Facebook, Johnson and Johnson, Alphabet. You can go to Nasdaq's website and check out their holdings. See, today, what choice do you have? Let's say you are the corporate treasurer, or let's say you are the pension fund manager. Let's say you are an insurance company. You have to pay retirement funds to your employees, or you have to pay pensions. You have to, if you are a university, you have to protect your money and grow the money for future. What do you do if interest rates are so severely negative, you have to go out and buy equities, right? Think about this. Unilever. Everyone is familiar with that company. In India, its subsidiary is called Hindustan Unilever. We all know the products. We are familiar with what they do, right? They have a credit rating in Europe of A+. Their bonds are trading at negative yields. If you lend money to Unilever, you will get back less than what you have lent contractually, legally. And their stock is trading at 3% dividend yield. Their stock is trading at 15 price earning multiple. So in terms of earnings yield, it is close to 7%. Is Unilever a sick company? Is it not growing? Answer is no. They just get 1/3 of their business from Europe. They have a large Asia business, they have a large Americas business, and they have on an average grown around 5 to 7% per annum. So why is the stock so cheap? Why is it giving such a high dividend yield when their own bonds are trading at negative yields? So I think we are in a situation where uh, the bonds and equities are seemingly on different galaxies. One is following its own laws, the other thing is following its own laws. And currently there's a big disconnect. That disconnect will get resolved. So net net, what are we to do as individual investors? One of the biggest deal that government of India is offering our citizens is our interest rates are among the highest in the world. So RBI today is offering 775 on a 7-year bond. Even corporates are able to borrow at lower rates in India itself. Forget overseas interest rates. NTPC will be borrowing at lower than this interest rate. But still, government will pay 775 on RBI bonds, 840 on Sukanya Samriddhi, 860 on senior citizen schemes. So one, our interest rates are the highest in the world. We not only offer tax-free capital gains on sovereign gold bonds, over and above that we pay 2.5% interest. So these kind of deals are not available anywhere in the world. In fact, Greece, which has defaulted or was on the verge of default very recently, now is borrowing at 2% per annum kind of interest rates. So our interest rates are completely disconnected from the rest of the world. So if you are very, very conservative, then these are good avenues to put money in. So all along I have been harping on this one thing: capital the world over is cheap. Inflation the world over is under control. Growth the world over is low. Somewhere it's flat, somewhere it's small positive, somewhere it's positive, like in India and China, but lower than what it was in the past. So in this scenario, don't get fixated on the past returns that financial instruments have given you or what companies have delivered. So historically, whenever people were asked what is the return you want from equities, people will say 15%, 20%. We are not living in that world. We are living in a world where rates are very, very low. So if your global interest rates are 0 to negative, if your corporate bonds, if your traded government securities are at 6.5 kind of levels, then equities will give you somewhere around 10, 12%. Don't expect very, very high returns from equities in the future. Given that we are in a low inflation, low growth, low interest rate kind of environment. Pare down your return expectations. Don't expect your property purchase to double in 3 years or 5 years or anything like that. That is not happening. However, when I say these things, people will say, oh, mandi aa gaya. Low returns does not mean negative returns. So mind you, I'm positive on equity investing, but I'm saying don't go in with very, very high return expectations, given that very high growth rate is not there. Also, it does not mean buy indiscriminately. So don't buy bad quality companies. Again, I have been harping on high valuations in FMCG stocks. Those haven't really corrected. Some quality names haven't really corrected. Buy selectively wherever the business is good and wherever the valuations have become attractive. So this I spoke about. Valuations in bonds and in equities are completely disconnected right now. That wire will get connected somewhere down the line. It's not that they will remain disconnected forever. There is no bubble in equities. Bubble is actually there in bonds. So be careful of global bonds. Either of these two are incorrect. Either the yield on Unilever bonds is incorrect or the valuation of Unilever equities is incorrect. I think both are incorrect. Unilever bonds will lose money and equities will make money. Same way with Unilever is just one random name I've picked up. Essentially Nestle or anything in the global context. So quality businesses are at compelling buys, if the valuations are attractive and if uh, everything else is fine. Don't get taken in by the headlines that you are seeing. Headlines will keep screaming, slow down recession, slow down recession. That is the time to buy. If you wait for all the news headlines to turn positive, you will be buying at 30, 40, 50% higher than what prices are right now. Given that so much money is available so cheaply, there will definitely be debt-fueled M&A, share buybacks, capex. Just think about this. And this is one reason where I admire the at least thinking of the finance ministry of uh, borrowing globally. If Greece can borrow at 2%, I'm sure we'll get a pretty competitive borrowing rate globally. There is enough productive thing to be done with money. You could put out renewable energy capacities, you could modernize the rail network, you could build ports, airports. Enough productive things can be done. Just imagine if you had free money, what all could you do with it? In a world with free money, I'm sure there are enough smart people who will figure out uh, ways to deploy those profitably. It's not that such levels will remain forever. So all the things we are complaining about right now, capex cycle is not there, uh, not too much activities there in capital markets, all that will get reversed in due course. The sad part is it will also create misallocation. So a lot of stupid things will get done. So when money was very cheap in late 90s, we had this dot-com bubble. So let's say pets.com and all kinds of things. Overcapacity got created in undersea cables for internet and all those kind of things. We had plenty of cheap money in 2007. It created a real estate bubble the world over, in developed countries as well as in countries like India. So again, unfortunately, the side effects will be bubbles and misallocations. So my advice is stick to quality. Don't get drawn into this. Seemingly both segments will look like making money. In one case, it will be permanent money. In the other case, it will be frothy money, where you will make a lot of money and then suddenly poof, everything will vanish. So stay away from bubbles which are going to get created in the future. And the time to stay in cash was 3 years back, 2 years back. Now is not the time to get fearful. Now is the time to actually start deploying money. Don't start now that, oh, now things are looking gloomy. Again, the time to sell your Maruti and Eicher is when everyone is optimistic, not when everyone is pessimistic. This is what I wanted to convey today, and happy to keep it interactive and take questions that you may have. Thanks. We'll take the live ones. Okay. So we'll take the live questions first, and then we'll move to Bangalore and then Delhi. Just wait for the mic to come to you.
Yeah, excellent presentation, Rajiv. We're in agreement on a lot of things.
Thanks.
Now this, and on the asset bubble, the biggest one that I'm seeing building up is one word called startup. Okay. Now my question is, you're talking of interest rates, low interest rates and all that, but India still the interest rates are very high, as you yourself
Correct.
have said.
Correct.
So how does that, isn't that a mismatch again? And we are not, most of us are not international investors. So we are not getting a lever at a 3% dividend yield. So
Correct.
can you just talk about Indian equities in the context of what you've said and in context of your statement that interest rates in India are very high?
Correct. So one is capital is global. So even though we are not investing abroad, foreigners are investing in India, right? The 775 on government bonds that I said is available only to you and to people in the room and to people who are Indian citizens and Indian residents. It's not available to foreigners and it's not available to NRIs. Okay? So the bonds that those guys invest in are already at 640 and thereabouts. So traded bonds are at much lower yields in rupee terms. That is one. Secondly, the M&A activity that can happen in India can be funded by foreign capital. The interest rates globally are low. They can fund a M&A cycle in India. They can fund a equity buying in India. Given that a lot of quality companies have corrected significantly in India, I think it's an opportune time even for people in India to buy equities. And it's a matter of time before rates are cut in India as well. So if you want to lock in interest rates, try and lock in while you are getting them. Maybe in 1 month, 2 months, 6 months, you will not get these rates.
Rajiv, I was just reading global newspapers. If you see the auto, sorry, it's the slowdown. If you go, it started with US almost 2 years back, which was followed by Japan and Europe, and now it's coming to Indian shores. It says this transition is slowdown is because of transition happening globally in terms of the EVs coming in, or how what how much is the transition part of it, and how much is the real part to that slowdown. Second thing is the capex cycle. In last 3-4 years, we've just seen companies being acquired. Not any major, even in a global site, we've never seen anyone create a new capex. A big plant has come. Is it like because the capital is cheap, you're going to see this more going ahead? And secondly, your views on India in terms of the capex cycle, if you can touch.
Sure. So auto, I think we have had 3 or 4 presentations. So we have spoken about the structural changes happening, and you are right about that. There is some structural element in terms of electrification, in terms of the shared mobility, which is ride hailing and ride sharing, and in terms of autonomy. So all these things are going around in the world. And in developed countries, one can say that part of it is structural, given that they have close to one car for one individual. And as ride hailing or ride sharing comes about, you need fewer cars on the road. So maybe some of it is structural. I don't think that applies for India, given the low penetration. In fact, if at all, if ride hailing, ride sharing picks up, we will have demand coming from that as well. So people who were earlier not able to even occasionally afford cars could take rides in them. So I don't think it's so much of a structural thing. And electrification will happen, but not so soon. And it's just that suddenly for a cyclical downturn, everyone is blaming structural factors. So like I said, in last 20 years, we have had uh, 4 slowdowns. So it's not that it's something new as such. Capex, definitely, whenever existing capacity is available for sale at cheap levels, first preference will be to acquire that. So let's say if you are in the market for a home, if a flat is available uh, 2000 square feet for, let's say, 2 crores on a resale market, and the builder is selling a flat for 3 crores, obviously consumers will buy the 2 crore flat, which is existing resale flat. So same way, if you are in the market to add cement capacity or add a power plant, if an existing cement plant or a power plant is available less than the cost of creating a new cement plant or a power plant, you will buy existing assets first. So till the time the existing resale assets are mopped up, you will not see fresh capacity creation. It's only when the existing excess supply gets dried out, then you see a new capex cycle. So I think it's a matter of time. First, it will go to existing capacity, and then the fresh capex cycle will start.
I want to come back to the topic of interest rates in India. So there is, in my mind there are two things happening. As an investor, you are getting very low interest rates, particularly beyond those small savings kind of investments. And on the other hand, there are so much rigidity in the system. So right from RBI, which is very reluctant to lower the interest rates and bring them at par with international level, to banks and NBFCs are making four plus kind of NIMs, at least the good ones. So we have such a, where in the other parts of the world the interest rates are negative. Here banks are charging intermediation fees of 4%. So the end result is for small businessmen, the interest rates are 15 plus percent, and that too, it's not easy to get the credit itself. So how do you, an interest, finance is one of the key factors of um, production, and we need to think about competitiveness of Indian industry versus global industry. There are so many imports coming from China, which has got much lower interest cost. So how do you think scenarios will change, and how will businessmen be able to have cheaper access to access to cheaper capital, and how will they become competitive, at least from this point of view?
That's a wonderful point that you are making. There is definitely a transmission issue of what RBI does and what actually rates borrowers are getting money at. So transmission has happened very smoothly in some segments and is very rigid in some other segments. In some segments, it's not happening at all. And so the question is quite detailed. There are many segments to it. Let's take those segments one by one. Firstly, your point of RBI not cutting enough. Actually, RBI has been ahead of the curve as compared to the central government and as compared to the banking system. So the RBI controls short-term interest rates. So those are down to 540 levels, let's say. Let's say 10-year government securities are at 6.5 or 640 or wherever they are. The small savings are at 775. So that's the big gap. The Labor Ministry has not cut EPFO rates. So those are kept at very high levels, which is preventing banks from lowering the deposit rates. If banks do not lower deposit rates, they have difficulty in lowering lending rates. So that's as far as the absolute rates go. The 4% spread obviously seems to be very, very high. Partly they are using this high spread to write off the past bad loans, which obviously is not fault of the current borrowers, but that's the unfortunate situation where the good borrowers are paying for the sins of the bad borrowers. So despite charging such a high spread, most banks are in losses, as you would have seen the results. Now, till the time the cleanup happens, the banking system will not be able to reduce the spreads too much because they have all these elevated credit losses that they have. About transmission. So today, if you are a home loan borrower with the best credit scores, you are able to borrow money very, very close to the rates at which you are able to deploy. Let's say if you are able to deploy money at 775 and 840 and at those levels, you are able to borrow at 8.5 or 9. It's not that borrowing costs are very, very high for you as borrowers. Corporates which have the best credibility in the market are able to borrow in commercial papers at sub 6% levels even today. It's the problem arises where small business persons, where they don't have too much collateral to offer and where they don't have enough of a credit history, those are the people who are vulnerable to high interest rates. Now, that problem still needs to be solved. But last couple of years, actually the scenario has got changed. Earlier, people were charging very high interest rates to individuals and small businesses, and they were chasing corporates for lending. Last few years, every bank is looking to increase their retail lending, and rates have really come down over there. So let's say if you are borrowing against gold, for example, rates are very, very competitive. It's not that you will end up paying very, very high interest rates. But it's just that if you are a very small entrepreneur and you have very spotty credit history, then you would end up paying 14-15% interest rates.
Okay, thank you.
Hi, how are you?
Hi.
6 months before you had given a presentation on 6 months before you had given a presentation on debt mutual funds and the mess they were into,
Yes.
especially the credit risk funds and the bond funds. So, what's your current outlook? Is the stress level reduced? And still, the question is that YTM in those funds are still above 9%. So, would you recommend with a 3-year, 4-year view? And the second question was definitely you're seeing value currently in Indian stock market is in auto sector. Which other sectors are you currently studying? Yeah, thanks.
Firstly, in debt funds, it's very difficult to give you a general answer. So let's say there are two funds, both have a YTM of 9%. Now one person has done thorough credit analysis and they've carefully chosen the companies where they have invested in, and per borrower exposure is not more than 2%. That's a safe fund. Whereas in another fund, if they've lent 10% of the corpus to one borrower who seemingly has a good credit rating but shaky balance sheet, that might blow up anytime. So what YTM you are looking at as 9%, in one default, the entire principal would go away, leave aside the yield. So it's very difficult to give a general answer. Broadly in debt, my assessment has been that, let's say, longer dated government paper is, let's say, 6.5, and short term or overnight money is, let's say, 540. Why is someone paying 9%? If someone is paying 9%, then there is a high element of credit risk there. If one is putting money in debt, I would rather buy those 775 kind of papers, or I would open a PPF account where it accumulates tax free, or I would increase my contribution to my voluntary provident fund. I would put more money in the government PF rather than buy credit risk funds. So I'm not a big fan of credit risk mutual funds. If you want liquidity, if you have short term money, liquid funds or short term funds with good quality paper is where I would be investing. And sectors, so more than sectors, I think better to go company by company and invest. But apart from auto, I think private sector banks also look good, given that a lot of loan losses have already been taken by them, and given that they will have better pricing environment, given that NBFCs are in trouble, and given that PSU banks continue to be in trouble, I think private sector banks should do well.
Yeah, with the amount of money which you said is giving negative returns, and which you analyze which it will be eventually deployed, what effect would it happen on the metals, especially gold and the currencies, currency in the relative term to India?
Sure, that's a great question. Very difficult to answer though. So it's like that floodgates have been opened at the dam. Now you'll have to know the trajectory of the water, which is a low-lying area, which areas will get flooded. But I take your point. It could go in gold. It could go in completely new things like Bitcoin. It could inflate art prices. It could inflate stock prices. We don't know what all asset bubbles it will create down the road. But take your pick. So much money is there, it will find an outflow somewhere and it will create asset bubbles. Very difficult to clearly say which asset class will gain to what extent, but any end, all of them could gain.
My question is about this $15 billion which they were planning to raise sovereign bond. And then people like Rathin Roy, who's part of the Prime Minister's Economic Advisory Council, he was very negative about it, he was very vocal about it. And I found it quite surprising, considering the fact that there is so much of surplus funds all over the world, and one can borrow at very good rates. If Greece could borrow at 2%, maybe India could borrow at less than that. So why is it? And it's not a large amount. It's we have reserves of 430 billion, and we're probably getting another 15 billion from Aramco. So how is this 15 billion such a big thing? I'm really not able to put the pieces together. Do you have any comments?
Puzzles me. I think whoever is very, very negative on India should watch that video, Know Your Country. I think that should be mandatory viewing for every citizen, in my view. For some reason, we just run down our own finances, our own government, our own corporates. Effectively, when we are running 400 or whatever our forex reserves, are lending money to all these Americans and Europeans at these low interest rates. We would rather spend that money in creating our own infrastructure. Why are we keeping such high levels of reserves, and why are we averse to all of this?
Actually, I thought they should have asked for 30 billion, instead of 15. 15 is too low for a country size of India. The amount of money we require for infrastructure and all, which requires long-term borrowing.
Yeah, the only,
so I thought the other way around.
Yeah,
Really.
so the only caveat, or the one reason where I'm not a big fan of government borrowing is that, and this has been my big disappointment with the government economic policies, previous 5 years and the current environment, is that they haven't addressed the chronic loss-making undertakings. So they haven't addressed the problems of Air India, MTNL, BSNL, Food Corporation of India, all of these. So if we are going to borrow money and flush it down the drain, then they should not borrow. If that borrowing is actually going to create productive assets, then I think they should. So one of the borrowing, so I was reading somewhere, all these metro rail projects that we are seeing in different cities, a lot of the funding is coming from foreign sources at very low cost. I think that's a great use of using low cost money. So one is it creates infrastructure, it creates ease of living, as the government says, and somewhere it is also saving forex reserves, because if a metro rail network is there, it will save you on oil import, let's say, directly, indirectly. Now that's a smart use of resources versus borrowing $15 billion and giving subsidy to Air India or to MTNL. So the disappointment has been with PSU reforms, or tens of thousands of crores being put into PSU banks year after year. I think that's a bad use of resources.
Rajiv, this is slightly a personal question from my side. So, the question that I have is, given the flood of global capital that is happening, which you've mentioned, right? How do you, or how have you kind of thought through your process of calculating the intrinsic value of the company? Because as investors, we're supposed to buy it at a discount to intrinsic value. We are at the same time competing with these global investors who are willing to buy a Unilever in India at a 50p because that's still a 2% earnings yield. Whereas our cost of capital is so high that, 50p or even mentally, it seems very expensive. So is there any sort of change to your thought process in valuations because of this evolution? And, how are you thinking through that?
Sure. So the valuations that we are used to, let's say in 2003 or 2008-9, those valuations are clearly not there. You are not getting a Marico at, let's say, 10-12 times earnings, or a Pidilite and 12-13 times, or a Kansai Nerolac at low teens kind of multiples, obviously. So some pay up is required. At the same time, just buy at any price obviously it does not work. So luckily for us, we have this mandate of buy in India or buy globally or whatever. So Unilever in Europe is not as expensive as a Hindustan Unilever here. So actually some stocks, even in India, or plenty of companies, especially in the small and mid cap correction or in the some of the cyclical corrections, there are individual names you can look at and find them at attractive levels. FMCG hasn't corrected, so over there I don't think opportunities have started coming yet. Great, Ronak, I think we'll move to Bangalore. I think they've been waiting. Ashwin bhai, I'll come to you again.
I have a couple of questions. I don't know whether I should ask them together or one at a time. So first, regarding what you just said, is that the world is awash in money, easy money, cheap money. But what we see as a symptom, at least in India, is we have started seeing some of the entrepreneurs, actually committing suicide and stuff like that. So now my number one question is, if money is that cheap and that easy, and the kind of opportunities and the amount of business, like for example, I'm referring to Cafe Coffee Day, the founder, right? So if money is that cheap, why are and he's just one example, right? Of people who are, if you read the newspapers every day, I see some of the other businessmen committing suicide despite the cheap money. That is number one. So my second question is based on one of your videos where you talked about the anti-fragile investing concept, right? How do you invest in an anti-fragile way? So my second question would be, would you say that your current portfolio is anti-fragile? That given where we are, the global economy is, that it is currently in a place where this portfolio can actually be called anti-fragile and can actually profit from the current global scenario. So two questions.
Sure. I'll just repeat the question. Uh, Firstly, you had a question as if money is so cheap, why are some people not able to borrow? And especially for example, the Cafe Coffee Day founder killed themselves given financial difficulty and problems of raising money. And the second was in context of anti-fragile companies, how are some of our companies positioned to benefit in a fragile world and how they will benefit from all the turmoil that is going around. So I'll answer these two. There are fundamentally two different concepts. One concept is liquidity. Liquidity refers to the availability of money and at reasonably attractive interest rates. That is one aspect. The second aspect is solvency. Now, solvency is a completely different aspect altogether. Solvency is when solvency is in doubt, your lenders doubt your capability of repayment. So, let's take the home loan companies, for example. Today, we have in the housing finance company space, we have companies like HDFC Limited, which is able to borrow money at reasonably attractive interest rates. And in fact, after the RBI policy rate cut, their cost of funding has come down. At the other end, let's look at maybe a DHFL, which has had difficulty in raising money. So why are people still lending money to HDFC Limited and not lending money to DHFL? It's because they doubt the solvency of DHFL. It's not a question of liquidity being there or not being there. So I think that's a somewhat different question there. So today we have had a fraud being disclosed in one of the listed companies in India. A few days back, there were question marks being raised on General Electric in the US. Yesterday, there was some social media forward going around about some accounting practices in Disney. Now, frauds or solvency issues will never be able to be overcome by liquidity. So even in the US, where interest rates are low, where plenty of liquidity is there, if the solvency of GE is brought into question, then their cost of funds could go up. So I think those are two different concepts. About anti-fragility, anyone who is not overextended in these times, anyone who has a unlevered balance sheet, I think they can avail of low cost funds to either acquire a competitor who is undergoing a stress on the balance sheet or those kind of things. So historically, we have never invested in companies with high leverage. Obviously, banks don't fall in that category, but other companies we have never invested in high leverage companies, and that makes them robust in a downturn. And given that a lot of them have excess cash on the balance sheet, they can acquire competitors or build capacity strategically. So that gives some anti-fragility to them. Yeah, next, please.
Hi, Rajiv. This is Jagrut here.
Hi.
one of the statement made by former RBI governor yesterday regarding the economic slowdown, and it's becoming worrisome for India. So what's your view on that? Still, do you still see that economic slowdown as just a cyclic process or something really waiting for us?
Okay, okay. Yeah, so slowdown is there visibly in terms of some sectors not having demand and things like that. So, as I was talking, it's like having a little bit of drowsiness or a little bit of a headache. The medicine that is being prescribed is very, very severe uh, the world over and even in India. I think that medicine definitely will have positive effects as well as some side effects. I don't think both can coexist. Such an excess amount of liquidity and such low interest rates and a permanent recession or a permanent slowdown. I'm not calling a bottom, or I'm not saying this recession will be over in 1 week or 1 month or 6 months or whatever. All I'm saying is that the stock prices in many companies already reflect the reality and the slowdown, and in fact makes them attractive purchases from a 5-year kind of uh, horizon. Uh, we do not know the timing of the recovery, but definitely a recovery will come. And currently we are seeing a somewhat of a slowdown, and growth is lower than what usually we have. Yeah, next please, we'll take one question from Bangalore and then we'll move to Delhi, please.
Hi Rajiv, this is Samir here. I have just one question. You talked about lowering the expectation on the equities. Can I understand, like in terms of the long term, what is PPFA's aspiration in terms of the returns in the long run? Do you lower it now, or do you kind of what has been your aspiration in terms of how would you like to grow?
Sure. When we look at returns, we look at returns in real terms rather than in nominal terms. So, real returns is the headline return number minus the inflation rate. So, given that historically equity returns were 15% and inflation was close to double digits, maybe 8% or 9%, we were getting real returns of 5 to 6%. I think in the future also real returns will not be that materially different from past returns, but nominal returns may look lower given that overall inflation rate and interest rates are lower. Great. I think we can now move to Delhi and take questions from Delhi.
Hi, Rajiv. Excellent session.
Thank you.
So I just had one question to ask you. See, the whole premise behind saving is that we delay consumption, right? So we delay consumption, we save 1 rupee so that we can get 1 plus X at a future date.
Correct.
So as I gather from what you are saying is that when we have such a plethora, tsunami of liquidity coming in and too much money chasing too few assets, so is that going to somehow take away the incentive to save? As in, do you see that affecting the incentive to the saving culture that we have? Like India, we say that we have a high savers economy. So do you see that getting affected, and how is it going to play down the line?
Wonderful question. So that is the objective of developed countries. The developed countries of Europe and Japan are trying to discourage saving, and they are trying to increase consumption. That is what they are trying to do to get out of recession. The scenario in India is that we still have positive real interest rates. So if we are saying our inflation is 4 to 5%, we still have money market rates of 5.5, government bond yields of 6.5, and small saving interest rates of close to 8%. So that situation is not there in India currently. India, I think, will continue to have a high savings rate and high investment rate. In developed countries, yes, they are trying to discourage savings and they are trying to encourage consumption. Next question, please.
Yeah. Hi, Rajiv. Karthik here.
Hi.
So my question is, given the current scenario, while looking at the companies, does the revenue mix at all affect our thesis about the company, and mix as with regards to the export versus the domestic side? So does a company selling the products outside give us some comfort, or the global slowdown, rather we should be looking inside, like our own companies that focus in India?
Sure, that's a wonderful question, and you caught me out on that. The talk that I gave today is not what we consider in investing at all. So, while investing, we look at each company on its own merits. So, all macro and all that is fine, and one has to be aware of the environment and context. But when it comes to individual company analysis, we look at each company on its own merits. Do we prefer exporting companies, or do we prefer domestic companies, or a mix of the two? Given that we invest in companies overseas as well as companies in India, we anyway have a diverse revenue mix, and we are exposed to various economies. We don't have preference one way or the other, whether it's pure domestic or pure international, or a mix of the two. What we want is great quality management, great business quality in terms of pricing power, in terms of return on capital, return on equity, low leverage. We look at the runway ahead of them in terms of the industry prospects, and we look at the valuations. We look at a mix of all of these factors, and we are open to all kinds of companies, companies which are exporting, companies which are domestically focused, or a mix of the two. Thanks. Next question, please.
Hello, sir.
Hi.
Sir, when we conduct a DCF, we generally discount at a rate. So, in corporate finance, we use a WACC, but Parag Paik sir always said that use a 10 to 15%. So I just wanted to know that, like, our equity return will be reduced in going forward, as you said. So should we reduce that number when we are valuing, or should we maintain that?
I think if you use historically relevant cost of capital, you will not find anything to buy, given the overall low interest rates and higher valuation. So one has to take into account the environment. So what Parag Bhai said is one should target something like a 15% return, and one should use something like that as a cost of capital. That was in the era of somewhat high inflation rates, higher interest rates. Given the environment, I think one needs to lower that a bit, but not too much, not like someone mentioned the startup kind of valuations or pie in the sky kind of valuation. Obviously, one has to be conservative there. But given that we are in a low inflation, low interest rate environment, we would have to peg that down a bit, maybe 10-12% kind of thing. Great. Thanks. I think we'll take one last question from Ashwin Bhai here in Bombay, and we'll wind up. I think we have overshot our time.
Yeah, Rajiv, coming back to the government's idea of borrowing money abroad, knowing the trend of the rupee for the last, I don't know, maybe 20, 30 years, that it's been constantly depreciating. Isn't that a great risk? I'm not talking about the amount of money that the government is considering borrowing, but as a principle, whatever we borrow now, 5 years from now, it's going to be tremendously expensive. Not the 2% that we're thinking that we're borrowing at the current time.
Correct. So historically, we have depreciated, let's say, roughly 4% kind of thing against the dollar per annum. That's been the historical thing. So even if one were to predict that in the future, it will be 2 plus 4 or 2.5 plus 4. It will again come back to our domestic borrowing rate effectively. The point Mr. Kishan Khanna was making, or where I am making, is overall, if at all one has to borrow at any point in time to create infrastructure in India at a large scale, then the time is right now if we want to do it, rather than when interest rates are, let's say, 16% or 10% or 8% in dollar terms. If interest rates are 2% in dollar and 0 in euro, then it's a more appropriate time to roll out that infrastructure. So, for example, the bullet train project, where they are saying it's close to 0 in terms of the borrowing cost. Now, without getting into the fundamental question, whether one should borrow to create assets or not, that's a separate discussion. If at all you are going to borrow, then this is the time. Let's say if there's a need in the home, need to buy a house, one should buy a house on mortgage when interest rates are low, rather than buy on loan when interest rates are high. That's the simple point I'm making. And given that we have surplus labor, we have plenty of people, and we have capital shortage, I think some amount of capital infrastructure would help in terms of improving the productivity. Net, if one assumes 4% rupee depreciation, we would be somewhere at the same interest rate that we are paying domestically. Great. Thank you so much, everyone here, for coming, and thank you everyone who joined from Delhi and Bangalore. See you next month.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.